Imagine paying more for almost everything while having the least room to absorb it. A bill arrives late, the payment is missed, and a fee is added. The car breaks down, but there is no savings buffer, so the repair is delayed, which creates transport problems, missed work hours, and new costs that spread into the next week. Groceries are bought in smaller quantities because cash is tight. Even though smaller quantities often cost more per unit. Time is spent solving emergencies that money could have prevented, and energy is spent recovering from problems that stability could have softened. For many people, this pattern does not feel like one dramatic crisis. It feels like ordinary life. Quietly, repeatedly, and often invisibly, the cost of having less becomes higher than the cost of having more. At first glance, this appears backwards. If someone has less money, common intuition suggests they should spend less money. Yet in many systems, lower-income households often pay more for the same outcomes, not because they are careless or irrational, but because scarcity changes the options available. When choices narrow, efficiency declines. When margins disappear, small disruptions become expensive. When every decision must solve the present moment, long-term optimization becomes difficult. Poverty is not only about the amount of money someone has. It is also about the price paid for limited flexibility. To understand this clearly, it helps to separate price from cost. Price is the number attached to a product or service. Cost is the full burden created by obtaining it, maintaining it, replacing it, financing it, or losing access to it. A cheap pair of shoes may have a low price, but if it wears out quickly and must be replaced twice as often, the long-term cost may exceed a durable pair that required more money up front. A low-balance bank account may seem manageable, but if it triggers overdraft fees, late fees, and stress-driven mistakes, the true cost becomes larger than the statement suggests. The poor often encounter lower prices paired with higher costs, because immediate affordability and long-term efficiency are not the same thing. This dynamic appears in housing. People with stronger finances can often secure lower interest rates, better neighborhoods, safer buildings, and leases that reduce uncertainty. People with weaker finances may face deposits they struggle to gather, limited housing supply, unstable rent increases, or locations farther from work. The rent itself is only one layer. Longer commutes create transport costs, time costs, childcare complications, and fatigue. Poor housing can produce maintenance problems, health strain, and disrupted sleep. Instability creates moving costs, application fees, storage costs, and lost routines. A cheaper monthly rent can become more expensive once the surrounding system is counted. The same logic appears in food. Buying in bulk is often cheaper per unit, but bulk purchasing requires cash today, storage space at home, transportation capacity, and confidence that the product will be used before waste occurs. Many households under pressure by smaller quantities more often because that matches immediate cash flow. Smaller packaging can carry higher unit prices. Frequent shopping trips create transport costs and time costs. Stress and time scarcity can also shift decisions toward convenience foods that solve the present hour while increasing long-term expense. Again, this is not irrationality. It is adaptation to constraints. Transportation offers another example. A reliable car can preserve time, income, and access, but reliability often requires upfront purchase cost, maintenance reserves, and affordable credit. Without those, people may rely on older vehicles with recurring breakdowns, expensive short-term fixes, missed shifts, or unstable commuting routes. Public transit may be cheaper in price while being expensive in time. Ride-hailing may rescue emergencies while draining future budgets. Each solution is understandable in context. The expensive part is not always the option chosen. It is the lack of stable options. Credit systems often magnify this pattern. Those with strong credit histories are frequently offered lower rates, rewards, grace periods, and flexibility. Those with weaker histories may receive higher interest rates, stricter terms, fees, or exclusion entirely. If cash flow is uneven, borrowing becomes a bridge. But expensive borrowing can turn temporary shortages into recurring obligations. Interest accumulates. Minimum payments preserve the debt while shrinking progress. One late payment can damage future borrowing costs. The person already under pressure may end up paying more to access money than the person who needs it least. This creates an important principle. Wealth often buys efficiency, while poverty often rents inefficiency. A person with reserves can prepay, compare options patiently, wait for discounts, buy durable goods, and recover from mistakes. A person without reserves may need the fastest solution available now, even if it is costly later. Speed has a premium. Emergency has a premium. Fragmented payments have a premium. Stress has a premium. The market price of urgency is frequently paid by those who can least afford it. There is also a psychological layer that numbers alone cannot explain. Scarcity captures attention. When money is tight, the mind becomes highly sensitive to immediate demands. This narrowed focus can improve short-term problem solving, but it often reduces capacity for long-term planning. Not because people lack intelligence, but because attention is finite. When survival consumes cognition, optimization becomes harder. The cost of poverty is partly financial and partly cognitive. Researchers often describe this as bandwidth tax. Constant financial pressure can make ordinary tasks feel heavier because the brain is processing unresolved threats in the background. Forms are delayed, appointments missed, comparisons postponed, and decisions simplified. Fees that seem avoidable from a distance become understandable at close range. If a person must choose between spending an hour disputing a small charge or using that hour to secure income, the fee may remain. Outsiders may see bad choices. Insiders often see constrained trade-offs. Mathematically, small penalties compound. Consider a recurring late fee, a slightly higher insurance premium, higher borrowing rates, more frequent product replacement, and transport inefficiencies. Each cost may seem manageable alone. Together they function like negative compounding. Just as investments can grow through repeated gains, financial strain can deepen through repeated leaks. 10 small disadvantages repeated monthly can rival one large setback. Because they are scattered across categories, they often go unnoticed as a system. This is one reason advice focused only on cutting coffee or skipping small pleasures can feel incomplete. Small savings matter, but they may not address the larger structural drains. Some dollars matter more than others, depending on where they are applied. Reducing a recurring fee can outperform dozens of minor sacrifices. Improving transport reliability can outperform obsessing over tiny purchases. Stability often has a higher return than austerity. Insurance reveals another layer of the paradox. People with fewer assets may skip coverage because premiums strain the monthly budget. This can be rational in the short term, yet dangerous over time. One medical issue, one accident, one theft, one major repair can erase months or years of effort. The inability to afford protection increases exposure to expensive volatility. Being poor can mean paying less each month while risking far more overall. Time itself becomes a hidden currency. Those with money can often buy convenience, delegation, proximity, and speed. Those without money may spend hours waiting, commuting, repairing, comparing, rescheduling, and recovering. Time lost can reduce rest, learning, family presence, and earning opportunities. Two people may spend similar dollars while living very different time realities. Health follows the same pattern. Financial strain can increase stress, reduce preventive care, interrupt treatment. Delayed care can become urgent care. Minor issues can become expensive issues. At a broader level, many institutions price based on risk, convenience, and predictability. Systems can produce harsh results simply by rewarding stability and charging for uncertainty. That distinction matters because it changes how the problem is understood. This is where identity can quietly shift in damaging ways. Someone paying more for weaker outcomes may conclude they are bad with money. Shame can replace analysis. Self-criticism can replace strategy. A more accurate frame is to ask where money is leaking through friction rather than where character is failing. Are fees recurring because due dates are mismatched with income timing? Is transport instability damaging earnings? Is debt interest consuming progress? Is housing distance consuming time? Is product replacement recurring because cheap goods fail quickly? These questions move attention from guilt to mechanics. The mathematics of improvement often starts with removing recurring penalties before chasing ambitious gains. A lower interest rate, an avoided fee, a reliable appliance, a better route to work, an automated payment, a negotiated bill, a consolidated obligation. These changes may appear small, yet they alter the system repeatedly. Because recurring savings compound, reducing friction can create breathing room. This breathing room has psychological value beyond the numbers. A modest buffer can reduce panic. Reduced panic can improve decisions. Better decisions can reduce future emergencies. Fewer emergencies can preserve the buffer. It is also important to recognize that progress may look slow at first. If someone has been paying hidden premiums for years, the first phase of improvement may simply stop the bleeding. Debt declines gradually. Fees disappear quietly. Stress eases before wealth appears. Outsiders may not notice visible success. Yet internally, the system is changing. Negative compounding is being replaced by neutral ground, and neutral ground is often the first real victory. From a societal perspective, reducing the cost of poverty can benefit everyone. Affordable transit can improve labor access. Fair banking can reduce extractive fees. Stable housing can improve education and employment continuity. The issue was never only the amount of money in hand. It was the cost of living without enough room to breathe.